Listen, I need to tell you something that might make you uncomfortable, but after watching markets for over 5 decades, I have earned the right to be brutally honest with you. Most people approaching retirement are holding 3 specific assets that are going to destroy their financial security, and they have no idea it is happening. They think they are being smart. They think they are being conservative. They think they are protecting themselves. They are wrong. And the tragic part is that by the time they figure it out, it will be too late to fix it. I am not here to make friends. I am here to help you avoid the catastrophic mistakes I have watched thousands of people make as they approach the most financially vulnerable period of their lives. Back in 1974, during one of the worst bear markets in modern history, I watched my own portfolio get cut in half. I thought I was diversified. I thought I was protected. I was young, arrogant, fresh out of Cambridge, and I believed I understood risk. The market taught me otherwise. I lost sleep. I lost confidence. And I nearly lost everything because I was holding assets I thought were safe when they were actually time bombs waiting to explode. That painful lesson changed how I think about money forever, and it is the foundation of what I am about to share with you today. If you are within 10 years of retirement, if you have worked your entire life to build a nest egg, if you want to actually enjoy your retirement instead of spending it in financial panic, then what I am about to tell you could be the most important thing you hear this year. Now, before we go any further, if this resonates with you, hit that like button right now. I am going to walk you through exactly which 3 assets you need to dump, why they are so dangerous, and what you should do instead. But first, let me be crystal clear about something. Retirement is not what it used to be. Your parents could retire on a pension and Social Security. You cannot. Your parents could count on employer benefits and Medicare covering everything. You cannot. Your parents retired into a different economy, a different market, a different world. The rules have changed, and if you are still playing by the old rules, you are setting yourself up for disaster. The average American needs about 80% of their pre-retirement income to maintain their lifestyle in retirement. If you were making $100,000 a year, you need $80,000 a year in retirement income. Social Security might give you $30,000 if you are lucky. Where is the other $50,000 coming from? Your investments, your portfolio, the assets you have spent decades accumulating. And this is where most people make the critical error. They think retirement means safety. They think retirement means conservative investments. They think retirement means moving everything into bonds and cash and real estate and just holding on. That mentality will destroy you. Here is what nobody tells you about retirement. You could live another 30 years. If you retire at 65, you might live to 95. That is 3 decades of inflation eating away at your purchasing power. 3 decades of market cycles. 3 decades of expenses you did not plan for. Medical costs that will shock you. Home repairs. Family emergencies. The retirement you are planning for is not a 5-year vacation. It is a 3-decade financial marathon, and you need assets that can survive that journey. But here's the advantage you have right now. You still have time. You are not retired yet. You can still make changes. You can still position yourself correctly. The people who get destroyed are the ones who wait until 6 months before retirement and then panic. You are ahead of the game just by watching this video and thinking about this now. Most people do not want to hear what I am about to tell you because it requires them to admit they have been wrong, and ego is expensive in the investment world. But you are smarter than that. You are here because you want the truth, not comfortable lies. Let me ask you something honest. Are you scared that your money will not last through retirement? If that fear keeps you up at night, comment what scares you most and add, "But I will win this fight." Your honesty could give someone else the courage to face their own fears. Now let me tell you about the first asset you need to dump before retirement, and this is going to upset a lot of people. Individual bonds, especially long-term government bonds and corporate bonds. I can already hear the objections. But bonds are safe. But bonds are conservative. but my financial advisor told me to move into bonds as I approach retirement. Your financial advisor is wrong. Here is why. We are living through one of the most dangerous periods for bond investors in modern history, and most people have no idea what is coming. For the last 40 years, we have been in a bond bull market. Interest rates have been falling since 1981. When rates fall, bond prices rise. Everybody who bought bonds over the last 4 decades made money, and they think that is normal. It is not normal. It was an anomaly, a once-in-a-lifetime trend that is now over. Interest rates have bottomed. They are starting to rise. And when interest rates rise, bond prices fall. If you are holding a 30-year Treasury bond paying 3%, and new bonds start paying 5%, your bond just lost a massive amount of value. Nobody wants your 3% bond when they can get 5% somewhere else. You are locked into low returns while inflation eats away at your purchasing power. But it gets worse. Most people do not understand that bonds can lose money. They think bonds are safe because the government or the corporation promises to pay you back at maturity. That is true if you hold until maturity. But what if you need that money before maturity? What if you have a medical emergency? What if the market crashes and you need to rebalance? You are selling at a loss. You just took a guaranteed loss on an asset you thought was safe. And let me tell you something about corporate bonds specifically. When a recession hits, companies start defaulting. Your safe investment becomes worthless paper. I watched this happen in 2008. People who thought they were conservative and smart holding corporate bonds got destroyed when those companies went bankrupt. High-yield bonds, junk bonds, they are called junk for a reason. The yields are high because the risk is high. You are gambling, not investing. Here is what you should do instead. If you want fixed income exposure, use short-term bond funds or a bond ladder with maturities under 5 years. Keep duration short so you are not exposed to interest rate risk. Better yet, keep a cash reserve for emergencies and put the rest of your money to work in assets that actually grow. Which brings me to the second asset you need to dump, and this might be even more controversial. Your primary residence if it is too expensive. I know what you are thinking. But I love my house. But I raised my family here. But real estate is always a good investment. Let me destroy that myth right now. Your house is not an investment. Your house is a liability that you live in. It takes money out of your pocket every single month. Property taxes, insurance, maintenance, utilities, repairs, and the bigger the house, the bigger the liability. Here is the brutal truth about retirement and housing. If your house represents more than 30% of your net worth, you are in trouble. If your property taxes and maintenance costs are eating up more than 15% of your retirement income, you are in trouble. If you are sitting on $1 million house with a $300,000 portfolio, you are house rich and cash poor, and that is a disaster waiting to happen. Let me give you some real numbers. Say you own a $800,000 house free and clear. Congratulations, you have no mortgage. But you are still paying $12,000 a year in property taxes, another $3,000 in insurance, another $5,000 in maintenance and repairs. That is $20,000 a year in costs just to live in a house you supposedly own. You do not own it. You are renting it from the government through property taxes. Now, $20,000 a year might not sound like much, but let me show you what that money could do if you invested it instead. $20,000 a year invested at 8% for 20 years becomes over $900,000. You are trading almost $1 million in investment wealth to live in a house that is too big for you now that the kids are gone. That is financial insanity. Subscribe to this channel if you want weekly strategies based on 50 years of real market experience. No hype, just what actually works. Here is what smart retirees do. They downsize. They sell the big house. They move to a smaller place, maybe even rent if it makes sense. They take that equity and put it to work generating income. Let me give you a real example. You sell your $800,000 house. You buy a $400,000 condo. Now you have $400,000 in cash after closing costs. You invest that $400,000 in a diversified portfolio of dividend-paying stocks. yielding 4%. That is $16,000 a year in dividend income. Plus, your housing costs just dropped by 60%. You went from paying $20,000 a year to paying maybe $8,000 a year in condo fees and taxes. You just freed up $12,000 a year in cash flow and generated $16,000 a year in dividend income. That is an extra $28,000 a year in your pocket. That is the difference between a comfortable retirement and a stressful retirement. But people do not want to do this because of emotion. They have memories in that house. They think their kids care about inheriting it. Let me tell you something. Your kids do not want your house. They have their own lives, their own houses, their own problems. What they want is for you to not be a financial burden on them in your old age. The best inheritance you can give your children is your own financial independence. Do not saddle them with a big house they will have to sell anyway while you struggle to pay the bills. Now, the third asset you need to dump before retirement is the most dangerous of all because it tricks you into thinking you are being smart. Actively manage mutual funds with high expense ratios. I am talking about funds charging you 1%, 1.5%, even 2% a year in management fees. You think you are getting expert management. You think you are getting better returns. You are getting robbed. Here is the math that will shock you. On a $500,000 portfolio, a 1.5% annual fee costs you $7,500 a year. That does not sound too bad, right? Wrong. Over 25 years of retirement, assuming 7% average returns, that 1.5% fee will cost you over $200,000 in lost wealth. You just gave the fund manager $200,000 to underperform the market. Because here is the dirty secret of the mutual fund industry. Over 90% of actively managed funds underperform their benchmark index over the long term. You are paying extra money to get worse results. That is not investing. That is being scammed by people in expensive suits. And it gets worse. These funds have high turnover. They are constantly buying and selling, generating capital gains taxes that you have to pay. You are getting hit twice, high fees and high taxes. Meanwhile, the fund manager gets paid regardless of whether you make money or lose money. They get their 1.5% whether the fund goes up 20% or down 20%. How is that fair? It is not. It is a system designed to extract wealth from investors and transfer it to Wall Street. Here is what you should do instead. Low-cost index funds. A total stock market index fund charges you 0.03% a year. That is $150 on a $500,000 portfolio instead of $7,500. You just saved $7,350 a year. Over 25 years, that is over $180,000 staying in your pocket instead of going to fund managers. And the performance is better. Index funds consistently outperform actively managed funds over the long term because they have lower costs and lower taxes. This is not opinion. This is fact, backed by decades of data. Warren Buffett, one of the greatest investors of all time, has said repeatedly that regular investors should just buy low-cost index funds. And if Warren Buffett is saying it, you should listen. But here's the part that makes me angry. Financial advisors keep pushing these expensive, actively managed funds because they get paid to push them. They get kickbacks. They get commissions. They get trips to conferences in Hawaii. Your retirement security is being sacrificed so some advisor can hit their sales quota. That is criminal, but it is legal, so you need to protect yourself. Ask your advisor how much you are paying in total fees. If they cannot give you a straight answer, fire them. If the total cost is over 0.5% a year, fire them. If they are pushing annuities with surrender charges and hidden fees, fire them. Your money is too important to trust to someone who is more interested in their commission than your retirement. Now let me give you the plan. 7 specific steps to clean up your portfolio before retirement and position yourself for financial security. This is not theory. This is based on watching markets through multiple crashes, multiple recoveries, and understanding what actually works when your financial life depends on it. Step 1, and you need to do this in the next 30 days, audit every single investment you own. Pull out your statements. List every mutual fund, every bond, every stock, every account. Write down the fees you are paying. Write down the performance. Write down what percentage of your portfolio each investment represents. Most people have no idea what they actually own. They have accounts scattered across 3 different brokerages from 3 different jobs. They have old 401k accounts they forgot about. They have investments their uncle recommended 10 years ago. Get organized. You cannot fix what you do not measure. This is your January task. Complete portfolio audit. No excuses. Step 2. Starting in February, dump every actively managed mutual fund with an expense ratio over 0.5%. Replace them with low-cost index funds. If you have $500,000 in expensive mutual funds, this one change could save you $5,000 to $10,000 a year in fees. That is real money. That is money that compounds in your favor instead of the fund manager's favor. Use a total U.S. stock market index fund for your domestic equity exposure. Use a total international stock market index fund for your foreign exposure. Use a short-term bond index fund if you need fixed income. 3 funds, that is all you need. Simple, low cost, effective. Do this in February and you will sleep better at night knowing you are not being robbed by fees. Step 3. In March and April, evaluate your bond holdings. If you have long-term bonds, sell them. If you have high-yield junk bonds, sell them. If you have individual corporate bonds from companies you do not fully understand, sell them. Replace them with either a short-term bond fund with an average duration under 3 years, or just hold cash in a high-yield savings account. Right now, you can get 4% to 5% on cash with 0 risk. That is better than most bonds with way less risk. Keep 6 months to 1 year of expenses in cash for emergencies. That is your safety net. The rest goes into growth assets because you have 30 years of retirement ahead of you. Step 4. Between May and July, make the tough decision about your house. Run the numbers honestly. Calculate your total annual housing costs including taxes, insurance, maintenance, utilities. Calculate what percentage of your net worth is tied up in your house. If your house represents more than 40% of your net worth, you need to seriously consider downsizing. If your annual housing costs are more than 20% of your expected retirement income, you need to downsize. This is not emotional. This is math. Talk to your spouse. Talk to a real estate agent. Get your house appraised. Start looking at smaller options. You do not have to move immediately, but you need to have a plan. Because if the market turns or your health changes or property taxes go up, you need to be ready to act. Do the research now while you have time, not in a panic later. Step 5. In August and September, optimize your tax situation. This is critical, and most people completely ignore it. Look at your accounts. How much do you have in tax-deferred accounts like traditional 401k and IRA? How much in tax-free accounts like Roth IRA? How much in taxable brokerage accounts? You want a mix because in retirement you want flexibility. Some years you might want to pull from your Roth to avoid taxes. Some years you might need to pull from your 401k for required minimum distributions. If everything is in a traditional 401k, you are going to get destroyed by taxes in retirement. Consider doing Roth conversions now while you are still working and can plan for the tax hit. Convert $20,000 to $30,000 a year from your traditional IRA to a Roth IRA. Pay the taxes now at your current rate instead of paying potentially higher rates later. This strategy alone could save you hundreds of thousands in taxes over your retirement. Talk to a CPA who specializes in retirement tax planning, not your buddy who does tax returns out of his garage. If you know someone drowning in financial stress, share this video with them. It might be exactly what they need to hear. Step 6. In October and November, build your retirement income strategy. You need to know exactly where your money is coming from. Social Security covers part of it. When should you claim? Age 62, full retirement age, or wait until 70? Every year you wait increases your benefit by 8%. If you are healthy and expect to live into your 80s or 90s, waiting until 70 could be worth hundreds of thousands of extra dollars over your lifetime. After Social Security, where's the rest coming from? Dividends from your stock portfolio. If you have a $600,000 portfolio yielding 3% in dividends, that is $18,000 a year in income without touching principal. Strategic withdrawals from your retirement accounts. The old rule was 4% withdrawal rate. That might be too aggressive now. Consider 3% to be safer. On $600,000, that is $18,000 a year. So Social Security plus dividends plus strategic withdrawals gives you your retirement income. Map it out month by month. Make sure the numbers work. If they do not work, you need to either save more now, work longer, or reduce your retirement expenses. Better to know now than run out of money at age 80. Step 7. In December, set up your portfolio for autopilot. In retirement, you do not want to be constantly managing investments. You want to set it and forget it. Establish automatic dividend reinvestment so your dividends automatically buy more shares. Set up automatic rebalancing once a year to maintain your target allocation. Maybe 60% stocks, 40% bonds if you are conservative. Maybe 70% stocks, 30% bonds if you are more aggressive. The key is to set the allocation based on your risk tolerance and time horizon, then stick to it. Do not panic sell when the market drops. Do not chase returns when the market rallies. Just rebalance once a year back to your target. This removes emotion from the equation. Emotion is the enemy of investment returns. Every study shows that investors who trade frequently or try to time the market underperform investors who just hold a diversified portfolio and rebalance regularly. Be boring. Boring makes you rich. Now here is the hard truth that most people do not want to face. Following this plan requires discipline. It requires you to make uncomfortable decisions. Selling your expensive mutual funds might trigger some capital gains taxes. Downsizing your house means admitting the kids are gone and you do not need all that space. Moving to index funds means accepting that you are not smarter than the market. These are ego hits, and ego is expensive. But you know what is more expensive? Running out of money at age 75 and having to go back to work as a Walmart greeter. You know what is more expensive? Being a financial burden on your children. You know what is more expensive? Spending your retirement years stressed about money instead of enjoying the life you worked so hard to build. The people who succeed in retirement are not the ones who made the most money during their careers. They are the ones who made the smartest decisions with the money they had. I have seen people retire comfortably on $500,000. I have seen people struggle with $2 million. The difference is not the amount. The difference is the plan, the discipline, and the willingness to make hard choices. So let me ask you directly, are you going to make these changes, or are you going to keep doing what you are doing and hope it works out? Hope is not a strategy. Hope is what broke people do. You are better than that. You have time. You have information. You have a clear plan in front of you. The only question is whether you have the discipline to execute. Most people will watch this video, nod their heads, feel motivated for about 24 hours, and then do nothing. They will go back to their expensive mutual funds, their oversized house, their long-term bonds. They will tell themselves they will deal with it later. Later never comes. And then they wake up at 65 with a portfolio that is not ready, expenses that are too high, and a retirement that is going to be much harder than it needed to be. Do not be that person. Start today, not tomorrow. Not next week, today. Pull out your statements, look at your fees, make a plan. Your future self will thank you. Drop a comment telling me which step you are starting with. Subscribe so we keep working on this together. And if this helped you, hit like and share it with someone who needs it. I will see you in the next video.